Prepare yourself, the big collapse of the United States dollar has just begun. After the first spike, the dollar has been falling steadily since the COVID pandemic in the United States last March. It tumbled to its weakest levels since the beginning of 2018, down about 10% to 12%, according to America's major trading partners. We're only in the third round of a 9-shot baseball game, based on a widely unpopular prediction I made in June that the dollar's value was down 35% by the end of 2021. If this forecast comes true, it will constitute an important exclamation mark for Joe Biden's first year in office, the 46th President of America. There were three main reasons for my argument that the dollar would fall. First, the current account as expected, the deficit, the widest measure of trade as it includes investments, worsened further and increased by 1.2 points to 3.3% of gross domestic product and 3.4% in the second quarter of 2020. The second quarter change was the largest erosion ever recorded, and the deficit now is the worst since late 2008. At work, there is a deterioration in domestic savings caused by explosive COVID-related increases in the federal budget deficit. When a nation lacks savings and wants to invest and grow, it must import excess savings from abroad to fill the circle, running current account deficits to attract foreign capital. Unsurprisingly, the identity is kept. Net domestic saving rate fell below zero in the second and third quarters for the first time in the last decade. The net domestic interest rate fell by 3.8 points to negative 0.9% in the second quarter, also the biggest quarterly decline in record. The fall in the second quarter was largely the result of the $2.2 trillion CARES Act aimed at providing financial aid during the COVID-related crash. While the pandemic and aftershocks are still widespread, a further $2.8 trillion financial aid is coming. Combined COVID aid packages total $5 trillion or 24% of 2020 GDP. Although not traditionally stimulating, this financial injection breaks all modern records by a wide margin. As a result, the domestic saving rate should fall below zero and put even more intense downward pressure on the current account deficit. 2. Euro. The pushback of my negative dollar call was all about Tina no alternative. In a follow-up comment, I challenged this claim by trying to create a positive case for the Chinese renminbi and the euro, while at the same time hailing precious metals and even cryptocurrencies. The Chinese yuan has gained nearly 4% since last June, and the euro moved little over the same period, although China should continue to strengthen as it led the post-COVID global recovery. As a born Euro-skeptic, I've always had a hard time saying anything extremely constructive about the shared currency. This is because the monetary union has a critical flaw, a single currency and a central bank, but no unified fiscal policy. The surprise came in July when German Chancellor Angela Merkel and French President Emmanuel Macron agreed on an aid package that included a regional financial repatriation in the 750 billion euros Next Generation EU fund. This adds the missing financial piece to the monetary union and provides a Hamilton moment for possibly the least valued major currency in the world. Gold prices, on the other hand, rose for a few months in June and July, but then withdrew these increases over the balance of the year. It was a different story for cryptocurrencies, having risen 4 times since June, or 2.5 times the spike at the end of 2017. Bitcoin was depicted as one of the largest speculative bubbles in history. 3. The Federal Reserve. When the current account deficit is under pressure, one might think that the central bank will often come to the rescue by tightening monetary policy. That is not the case with today's Fed. By adopting new average inflation targeting regime, the Fed sent a signal that it would move later, not earlier, to counteract any increases in inflation rates. As the United States becomes increasingly dependent on foreign capital to compensate for its shortfall in domestic savings, and the Fed's open-ended quantitative expansion creates an enormous burden of excess liquidity, the further sharp weakening of the dollar seems more compelling than ever. An economy on the verge of an ongoing pandemic and double-bottom recession leaves the Biden administration no choice but to opt for another round of major financial aid. This result will have consequences for any economy. Saving short means a weaker dollar for America. Keep COVID rescue programs or risk triggering stock market crash, warns IMF. The International Monetary Fund said governments and central banks should either continue their pandemic recovery programs or risk triggering a stock market crash. Warning that there are legitimate concerns about the stock price bubble, the Washington-based agency said a correction could occur in stock markets without low interest rates and government subsidies. In a report released to coincide with the World Economic Forum, the IMF said investors were ignoring recent data showing that major economies were slowing as the pandemic continued throughout the winter months. There was also the possibility that vaccination programs would take longer to spread, especially in the developing world, and force governments to maintain restrictions for longer. Financial markets have recovered since last March, with some reaching new highs. A cross-section of the top 500 US companies, the S&P 500, suffered a third drop from the high before the 3,386 outbreak last spring. It has since risen over 13% from its February 2020 level to 3,849. The FTSE 100 in London was 7,534 in January last year and struggled to recover from a 2,500-point drop. It hit a one-year high at 6,873 earlier this month and has dropped to 6,638 this week. The IMF's head of financial stability, Tobias Adrian, and his deputy Fabio Nattalucci said in a blog accompanying the report that investors can bet on a persistent policy pullback, and a sense of peace of mind seems to permeate the markets. They said the herd mentality was catching up with the markets, which meant that most investors ignored the warning signs of the economic slowdown and moved to a longer climb to pre-epidemic activity levels. This increased the risk of a market correction or repricing, they said, a sharp, abrupt asset price correction. For example, because of a persistent increase in interest rates could lead to tightened financial conditions. This can interact with existing financial vulnerabilities, creating knock-on effects on trust and jeopardizing macro-financial stability. They said that this left central banks with low interest rates and governments with no choice but to continue state support programs, as reducing their scope or generosity would cause panic among investors. The report said that a forward-thinking approach to vaccines is a particular threat that limits access to developed countries. Delayed access to comprehensive healthcare solutions could mean an incomplete global recovery and jeopardize the global financial system. While emerging market economies accounted for around 65% of global growth, excluding China around 40% in 2017 to 2019. Delays in dealing with the pandemic in such countries could worsen for the global economy, he said. Supply chain disruptions can affect corporate profitability even in regions where the outbreak is under control. And because growth is such a crucial component to financial stability, irregular and partial recovery risks jeopardize the health of the financial system. If you make any investment or legal decision, it is advised to consult an expert before making this decision.